Good afternoon, everyone. This is Unusual Activity powered by Financial Juice. This is the Unusual Activity Pulse edition. So, a few things that we'd like to talk with you about today. Continuation from some of the discussions in the morning. A few things making headlines so far in the morning. Quick check on the market. Certainly, we have S&P futures up 1.25 at 1848.25. So we also are very fortunate to have a guest speaker with us today as well, and we encourage you to ask questions in the newsroom, and we'll do our darndest to answer those. So a few things that we're going to uh, discuss with you today. And that is, certainly Ballard's comment today suggesting an extension of QE. Yes, I said darndest. Isn't that amazing? He suggested a QE, extending QE. If this goes through, should the Fed consider this? One of the things that we mentioned is he's not a voting member. So this is something interesting, and we'll have our guest discuss, the current economic conditions and whether or not the U.S. can decouple from the weakness that we currently seeing globally. Certainly, we'll some things that are trending is the Goldman Sachs, whether good earnings, bad earnings, what's the reaction in the market. Yes, there was a compensation reduction. Also, also uh, some trending with respect to VIX, XIV, SPY. Um, Also, OSUR is trending. We mentioned this earlier with respect to an Ebola test coming from this morning from Canaccord. Certainly, Ebola has been in conversation for quite some time and considering. And also, if we have the time, we'll interject with Netflix. Certainly, we saw the downdraft in Netflix yesterday. Currently, Netflix at 349.39. So we are we'd like to welcome back to the program a gentleman named Scott Nairns. He's a resident economic economist and source of the ideas that we like to bounce off of. So Scott, welcome back to the program, to Unusual Activity. This is the Pulse Edition midday, something, and occasionally um, we'll have some questions in the newsroom, and we'll go from there. So Scott, what I want to jump into this Bullard commenting this extension of QE. What your thoughts are? There was a rather significant reaction in the market, wouldn't you say?
Yeah, I mean, there was certainly can you hear me okay?
Yeah, I think we're good.
Yeah, that there's certainly a bounce in the market. I mean, I think it's short-term lived, and until you get some fundamental news, you can have this instability, which is great if you're a trader, but certainly makes it a little bit uninvestable for the rest of the investing community. So,
So let's extrapolate just for a moment. So let's say they do extend this extension,
mhm.
right? What's the reasonable? I mean, you've been around for a while, right? So we've had this is, let's just if they do, would this be like QE3 with like a little asterisk or something? How long do we go out? What's your thought on that?
I mean, most of the investment community thought that they would begin to start raising the towards the second quarter of 2015. So now that you have this major glitch with Europe, the U.S. economy, it's okay. We're not operating on all eight cylinders, but we're not dying either. So we're okay. The numbers out this morning, the employment number, the 5.9%, everything is good. There's no economic number that has come out yet that has led anyone to believe that we're slipping into a recession or we're going to or we're going to be in a European situation. Since Europeans are our number one trade partner, we seem to be okay. But that said, Europe is going to sort of stifle the rest of the investment community for a while. So they're taking steps to sort of bootstrap the economy and staying ahead of the curve by not raising, sort of going out and extending it, whether they're going to or not. I think that might spook the markets even more because they're not sure whether or not they actually will go through with that, and that gives people concern. I don't see them raising anytime soon. I think that's off the table, at least for the foreseeable future. You know, you take a look at the bond market; it tells you everything you need to know. But with respect to what's going on with Europe, it's a question. There could be some sort of coordinated effort over the weekend to stabilize markets through Draghi and Merkel. I don't think Germany is going to sit back and quietly let the rest of the EU take them down.
Scott, should Europe go into recession? Right? There's this concern of possible deflation. Right? We don't want to throw the D word out yet. It's a little bit early for that. The numbers that are coming out from Europe are a bit alarming, right? There's a bit of a slowdown. Should the recession occur, can the U.S. decouple from that potential contagion?
The answer is yes. However, we'll still be affected because they're not a huge trade partner for us, but we're still going to be affected if the rest of the world is collapsing. I'm not saying Europe is collapsing, but if they were to, it would certainly affect us. It would affect us in ways that not only a trade partner, but in travel, in our GDP might suffer. So it's not good. You want the rest of the world to sort of come along with you and dance at the same party.
So here's a question from one of our newsroom listeners and participants. So there's been a massive scare but not capitulation, yet has driven G3 countries' long-term weighted yield to new lows. Okay? What's your opinion? Can we hit a G3 10-year 1% without central banks' massive intervention? What's your thought on that? Yields are you look at the yields in Europe, they're rather low. Right, you look at you talked about the ARB, for example, in whether it's the Bund or whether it's the Spanish bonds. What's your thought? I mean, how low can these yields go?
Domestically or
both?
I mean,
domestic and international.
I mean, it's a function of where are people going to feel comfortable putting their money. Seems like right now they don't care what type of return they get, they just want safety. So they're going into bonds at 10-year at 2% is somewhat unprecedented, but they want safety. They're not willing to put risk back on the table. If we really are slowing, if we really are slowing down in our economy and the market, then people are not going to go into the stocks as heavily as they were before. But I'd be surprised to see it. I think it's too early to tell. We don't have enough economic numbers out to see a consistent pattern. I'd like to see a moving average of some time.
One of the things that we brought up yesterday is this fact that, remember, clearly U.S. Treasuries are in dollar denominated, right? For the safety piece, as investors are investing in U.S. Treasuries, they have to buy U.S. dollars to do that. So clearly, you're seeing a strength in the U.S. dollar, right? So is there something that would change that scenario for you as we're where do we possibly go with the U.S. Treasury. How low can I mean? We're just talking about this. Can we hit below 2? Can we hit 1.5? Something ridiculous?
I mean, you know, yes, yeah, you can. I don't predict it, but the law of averages state that we're we're going to hit 1.5 before we hit 3%. So I don't know unless there's a major exogenous event whether we'll hit that, but we could simply just melt down. Um, I'm not convinced. I got to tell you, I think a lot of this is a byproduct of the European situation, Ebola, um, earnings, um, which we're just beginning in that season. But I also saw Goldman Sachs earnings this morning, and Lloyd Blankfein, CEO, comes out and says, you know, I attribute it to strong U.S. economic data and improving economic conditions. However, he tempered his comments by saying that conditions can quickly change.
Correct. I think that was the main asterisk that I picked out
Yeah,
this morning as well. And something, Milton and I were talking about this morning is, I think it seems as though, I don't want to say they're preparing themselves for a particular downturn, but should a downturn happen, should something occur, I think it's almost like they have to put that now in
that caveat.
that caveat into their statements. So I think that's pertinent. Milt, I know you had a question.
No, yeah, Scott, I have just a quick question. We
Yeah.
mentioned the fact of the 1.5, possibility in the 10-year yield.
Yeah.
How do you think that would correlate into market, the action in the market? Would that be would people see that as a net negative and continue with the sell-off in the markets? Or would you see, or will people be like, you know what? Well, the market may see it negative, but my mortgage is going to be cheaper, or some interest rates will be, lower. How would you, as a trader or investor, take that, let's say 1.5 number, God forbid, 1.5 number? How would you take that into, trading this market?
Yeah, I mean, and that's a great question because you can look at it two sides. From a consumer, I take a look at it and say, well, mortgage rates come down, you could refi, things are cheaper, oil comes down, and I'm paying less at the gas pump.
Correct.
So that's great. But economically speaking, things don't come down to bonds don't, or yields don't come down to 1.5% unless there's a real issue overall, geopolitically, economically. There's something really going on that people just they're willing to put money at whatever yield they can for safety because they want risk off the table. So yeah, I think that sentiment has a lot to do with the market and investing strategy. And the sentiment right now is not good. Irrespective of the economic numbers, the sentiment is not good. So you have to sort of wait and watch it play out. You need oil to stabilize. There's a lack of demand there. They're not going to cut production. And while the prices are coming down at the pump, it's still not. It doesn't bode well for your economy. Rates coming down is great, but again, a strong economy is always, with higher rates, is always better than a cheap mortgage interest rate. I mean, that's the way I view it.
Well, one more quick question, then I'll let you guys
No, please.
finalize this afternoon show. The markets are clearly getting hit the past few days. Mindsets have changed. Action has clearly changed from what it was 2-3 months ago. In your opinion, Scott, what do you believe is, the chain of events that need to happen that you could think to yourself, okay, this may be either a short-term bottom or this may be the bottom? What would you want to see? You mentioned oil stabilizing. What else is there that investors or traders should keep an eye on, in your opinion, to think to themselves, okay, this is this is where people have their ideas of where this thing could stop. That's everyone that I talk to, everyone wants to know is, when is it going to stop? When am I able to be going to jump back into this market and try to make some money to the upside?
I think you need a headline. You need, in my mind, you need a coordinated effort from the EU to stabilize the markets over there. As I said, we are okay. We're not great. We're not bad. We're okay. Europe is an issue. So we need some sort of headline to come out of a coordinated effort to stabilize those markets. That will get their bonds from bleeding down, or rates from bleeding down. That will stabilize oil. That will begin to start this massive inertia necessary to get the economy moving to where we need it to be in Europe, because all we need to do is stabilize them, and that'll, of course, inadvertently, sentiment-wise, help us as well.
Thank you. I want to jump into just briefly Goldman Sachs. I know, they had a compensation reduction. So many opinions are out there. Are we really just seeing kind of a market effect on a, I don't want to call it the darling of stock market, but certainly it's a very, very well respected organization. Are we seeing just a bit of a benign reaction to earnings? What's your take on that?
I can't really comment on the inner workings of what's going on in Goldman. I know that compensation reduction, most people would be very, very lucky to earn what Goldman employees earn.
No doubt.
So, but I don't know the inner workings of it. I don't know what spending they have and why they were it.
Got it. So, so a couple of things. What did I know you talked to a lot of people during the week, and what's your take on? Give us an idea of where you think is the fear factor with this whole Ebola thing real, or is it something that market participants are legitimately becoming concerned with?
Yeah, I mean, I think it's a combination of both. I think it's a perception, and people perceive this to be very real. No different from SARS in 10 years ago in China. No different from AIDS. We'll get it under control, but it scares people initially, and rightfully so. So I think that has something to do with it, but isolated handful of cases. It's not a pandemic as of yet, and I think we need to wait and see as the new news gets disseminated.
Absolutely. And Hugo, thank you very much. You've been so adamant in putting in questions, and we talked about the decoupling. Certainly, I think you're right. You bring up the semiconductor U.S. companies in the S&P 500 have 80% of their revenues outside of the U.S. So can we decouple again? The conversation continues. Some comments coming through from Hugo, but Hugo, thank you for that. So we'll continue to monitor this markets. We'll continue to watch the headlines that we discussed in our morning shows and unusual activity. We want to thank Scott for being a friend of the show. It's great having you on, and so this is it's a good maiden voyage for our midday show here. So folks, thanks for joining us. This has been Unusual Activity Pulse, powered by Financial Juice. Many thanks to Scott Nairns. Hugo, thanks for the questions and the comments. We hope you continue to have a great day, and thanks for joining. Take care.